Kirloskar Oil Engines is in focus right now. The stock is taking a knock in trade. Numbers have come out. Numbers show margin improvement. But if you look at the 1 year chart, look at that, 280 rupees was the kind of levels when they had announced an analyst day, and there was a very big detailed presentation shared, and the stock has doubled within this year itself. Gauri Kirloskar, who is joining us right now, MD of Kirloskar Oil Engines, to share with us the roadmap from here on. Gauri, morning. Thank you very much for your time. There's a margin expansion as well, but the street appears to be slightly nervous on your numbers today, if today's reaction is concerned. But I'll take the clock back. You had indicated how the business will grow on a next 3 to 5 year basis in your February analyst day communication to the street, which happened itself after several years. Are you on track to that guidance, the direction which you had guided towards, if I were to look beyond the quarter to quarter kind of movement?
Sure. Thank you very much. And thank you also for having me on the show. So the strategy actually was announced last year in August. And what we had said at a broad level was 2x, 3y. So there were 3 pillars that we were focused on. This was doubling our revenue to 6,500 crores by FY26, as well as achieving a double-digit margin. The second pillar was enhancing customer satisfaction. And the third was becoming an employer of choice. So when I see where we are in that journey today, I'm pleased to report that we're well on track. If you look at this half year and the results that have come out, we have achieved a 19% year-on-year growth in the first half of FY24. And also, if you look at it from a base year of FY22, we are actually tracking at 25.5% CAGR. And the CAGR that we would have to achieve to achieve 2x, 3y is 26%. So we're very close to that. If you look at our margins, and I'll also speak a little bit about, perhaps why we're seeing a knock in the stock market, is because if you look at the half year, we have achieved double-digit margins. But if you look at the quarter performance, it's a transitory quarter because we've just been through an emission norms change. And we have seen a reduction in volume in Q2 as compared to Q1 because there was a significant pre-buy in Q1 that happened because of the CPCB4 norm change. And because of that volume reduction, we have the operating leverage not kicking in, and therefore a knock on margins per se in Q2. At the half year level, though, we're well on track, and I'm confident that we are building a strong base of sustainable profit. If you look at the second 2 pillars, enhancing customer satisfaction, we just actually launched some products last month. Of course, our whole range of CPCB4 gensets, but also a new range of what we call our Opti Prime series. And this has really been designed keeping the customer in mind because this product achieves fuel efficiency. It can save costs up to 20% for the customer, and it can also reduce emissions up to 50%. So without going into too much technical detail of what this product is, I would say that we're really as a company thinking about how we design products from the customer point of view. And the third one, which is becoming an employer of choice, we're investing in people and we're investing in developing the capability of people. And I think the metric that we track here really is employee retention rate. And I'm happy to say that since last year, we're seeing an improvement in retention of employees at Kirloskar Oil Engines.
Point taken, Gauri. You're talking about how this entire volume shift is transitory. But when do you expect the recovery? Are you expecting it in Q3 itself, or will it take some more time?
So if you remember what happened with CPCB4, just 2 weeks before the deadline, there was actually an extension of the CPCB2 emission change as well. So today we're in a pretty complex situation when it comes to supply chain and manufacturing, where we're actually running an unemissionized line, which is a CPCB1 emission norm. CPCB2 is continuing, and we have CPCB4. So in certain market centers, such as if you look at Delhi NCR, we have very strong CPCB4 demand coming from there. But apart from that, we really see the CPCB2 continuing as well. So if I speak about order book, and if you're talking about this transition, I'd say that the transition is going to extend out over this year until next July. But if we look at our order book, it's actually very strong in power gen. for both CPCB2 as well as CPCB4. And we also have a strong order book from the industrial side because we're seeing that continued spend in terms of infrastructure, and we have quite strong orders from the railways, defense, etc.
You've clearly outlined the growth direction and the strategy you will actually deploy to achieve that growth. But we are also gathering that there's a lot of impetus being given on product development and extracting efficiencies on the shop floor. We gather you are spending a lot of time with your engineers at the shop floor yourself. What kind of margin levers are you pressing so that these better designed products would actually give you get a higher sense of profitability as well in this growth trajectory which you've taken up?
Sure. So, I think that generally when we look at margins in our business, and I've spoken about this during our strategy, is when we look at the high horsepower range, so building larger engines. And today I'm happy to say that, as an Indian company, we have developed most of our engines and gensets in-house through our 250 plus engineers that we have here. And we have the largest range. So we go from 1.1 liters to almost 50 plus liters in terms of our engine range, which is the largest in the industry. And it's all developed in-house. But if we look at where the margins profile kicks in, it's really on the high horsepower range. And we have started to move there. In fact, the product launch that I just mentioned, the Optim Prime range now actually allows us to go up to 3000 kVA. Our previous range was only up to 1500 kVA. So these are obviously highly technical products which command a better margin. That's number one. The second is exports and the continued focus on exports. Now, exports takes time, but we are investing into seeding these markets. The most recent development at Kirloskar Oil Engines is that we have appointed an exclusive GOEM in the Middle East. So a GOEM is a genset OEM. So that will help as well in building the export business. And the third is, of course, service or our aftermarket business. And as our products get more and more technical, service also then becomes more proprietary. So as we increase our service penetration, and that is what we're focused on, we will start to see the margins expand.
On that note, we'll let you go. Thank you so much for joining us and articulating your strategy. So candidly, appreciate you making time.